Hello, my name is Sean, and I'm joined by Obi, Olivia, Sam, and Zach from Appalachian State University. We are presenting a sell recommendation for the Albemarle Corporation with a target price of $95.50, representing a 37% downside from Friday's closing price. We believe ALB is a sell because its business mix and contract structure will prevent superior profitability. Also, its balance sheet strategy to fund capacity conflicts with maximizing shareholder wealth. And finally, Albemarle is not the environmentally friendly pure lithium play that investors think it is. Albemarle is a specialty chemicals company that operates in three distinct industries. It holds revenue and capacity leadership in the lithium and bromine industries and operates in a niche marketing environment in the catalyst industry due to the customizable nature of a catalyst unit. The bromine and catalyst segments acts as a hedge when the price of lithium is low, but prevents the company from recognizing superior gains when the price of lithium is high. For example, let's take a look at Livent, a pure lithium competitor. In 2018, when the price of lithium was high, Livent's gross profit margin was 10 percentage points higher than Albemarle's. Unfortunately, Albemarle's diversified business mix will hurt its profitability as the price of lithium rises. We also believe that the company's long-term contract structure will prevent superior profitability. 90% of Albemarle's total lithium volume is contracted. Rising prices puts the company at a disadvantage relative to competitors who rely solely on the spot price. We also expect Albemarle to recognize a lower selling price in 2021 than in 2020 due to customers renegotiating contracts. However, even if we assume that Albemarle can sell lithium at a 10% premium to the spot price throughout our forecast, our sell recommendation still holds.
While Albemarle's mature segments act as cash cows, providing much needed funding to the lithium segment, the company's capital expenditures have exceeded its cash from operations since 2017. This means the company must continue raising capital to fund its plans for additional capacity. However, Albemarle's credit agreement restricts its debt to EBITDA to 3.5 after 2021. The company is currently above this threshold, and we anticipate Albemarle will de-lever throughout 2025 in order to remain in compliance with its agreement and improve its credit rating. Yet, even if we maximized Albemarle's debt to EBITDA and directed all funds toward CapEx, significantly growing lithium unit volume, our sell recommendation still holds.
Conversely, Albemarle can issue new shares, but this comes in conflict with maximizing shareholder wealth. When the company issued $1.3 billion of common stock, it caused more than just dilution. It raised our cost of capital to 11.1%. Our forecasts now show the return on invested capital never coming close to the weighted average cost of capital, even assuming that lithium demand will grow at a 43% CAGR. We used a benchmark of 2% above and below the WACC to distinguish value creation from destruction. Unless the price of lithium increases to $34,000 per metric ton, a price we believe is unsustainable, Albemarle will destroy value to grow lithium.
We utilized the scores of multiple third-party ESG data providers to compare Albemarle's ratings to its competitors. Despite seeming like an inherently good ESG company playing a key role in EV adoption, Albemarle has shortcomings that aren't reflected in its ratings. The company scores 3 out of 6 on the entrenchment index, which is worse than the average of 2.4. This is indicative of circumstances that bolster the board's power at the expense of shareholder rights. Albemarle's high social rating is driven by perfect community and human rights grades, but Albemarle's high social rating fails to reflect the impact that the company has in the communities in which it operates. In Chile, Albemarle extracts lithium from a salt flat in the driest desert on the planet. Lithium production uses over half of the water in the region, which has forced indigenous people from ancestral land. Chilean regulators are currently reviewing how water is allocated, which could cause Albemarle's expansion plans to evaporate. The production of lithium in Australia is not without its own environmental challenges. Hard rock extraction yields tailings which contain harmful chemicals. Albemarle transports these tailings 500 kilometers into Australia's interior, which has sparked protests in the affected region. While EV adoption is an important element of mitigating climate change, an electric vehicle charged by energy produced from coal actually nets more emissions throughout its life cycle than a traditional vehicle. The world currently relies on fossil fuels for over 80% of all energy produced, and until EVs are powered on grids fueled by renewable energy, their environmental benefits will be diminished.
While insiders and institutional investors appear bearish on Albemarle, we believe that retail investors view the company as a pure lithium play and are charging up the stock price in expectation of an EV boom. In the past 3 months, commenters on the company's Yahoo Finance discussion board mentioned 3 positive words for every 1 negative word. The bromine and catalyst segments were hardly mentioned, while the lithium segment was mentioned 89 times. We believe this textual analysis, combined with increased volume on Robinhood, supports that retail investors are trading with enthusiasm for the lithium segment. Our valuation, however, does not support this level of excitement.
We arrived at our target price using 3 multiple-based valuation methodologies and a discounted cash flow. We considered 14 competitors across the 3 industries Albemarle operates in. However, we ultimately chose one clear comparable for each of its segments. For lithium, we utilized Livent, a US-based lithium pure play with similar South American brine operations. For bromine, we identified Israel Chemicals, and for catalyst, WR Grace. We derived our forward multiples by averaging these companies' historicals weighted at each comparable segment's percentage of total revenue. This methodology yielded a 24 times PE and a 12 times EV to EBITDA. Multiples on the high end of Albemarle's historical range are justified by our growth expectations for lithium. However, they do not justify how investors are currently valuing the stock. In order to more directly account for Albemarle's business mix, we valued the company using a sum of the parts approach with EV to revenue multiples. We priced lithium at 8.5 times revenue, higher than Livent's historicals due to Albemarle's superior market share and ability to fund growth with its other 2 segments. We valued bromine and catalyst consistently with industry averages. Our sum of the parts analysis yielded an implied total EV to revenue of 4.2 times above all of Albemarle's historicals due to our high lithium multiple. Even when we price lithium so high that it is 78% of the value of the business, we still cannot justify a buy. Our 4th valuation methodology is a discounted cash flow. While we grow unlevered cash from operations at 19% for the first 5 years of our forecast, significant capital expenditures forecasted based off of Albemarle's capacity expansion plans will negatively impact free cash flow. Our 11.1% WACC is heavily dependent on Albemarle's cost of equity due to its premium equity valuation. Our 2021 intrinsic value estimate supports our relative valuations.
Our final target price of $95.50 represents a significant downside from last Friday's closing price. We compared our valuation to that of other analysts and found that in the last 2 quarters of 2020, they raised their target prices by nearly 70%, despite no changes in earnings expectations for 2021. Instead, analysts raised their PE multiple, but we're confident in our estimation of fair value, and it does not support those multiples. We tested the sensitivity of our target price by stressing the major assumptions in our forecast with a Monte Carlo simulation. This indicated a sell 98% of the time. We found that our target price was most sensitive to our lithium price and unit assumptions. However, even if we assume a 73% CAGR in unit volume, our sell recommendation still holds.
We also considered several other risks. New methods of lithium extraction have generated buzz in the industry, but with experts stressing the primitive nature of this technology, we believe the industry's optimism is premature. If lithium extraction is the buzz, then sentiment surrounding mainstream EV adoption is the whole beehive. However, we believe overly eager investors will get stung as EVs continue to be plagued by weakened consumer confidence, driven by a time-consuming charging process and costs that the average consumer cannot justify, areas which the new infrastructure bill fails to adequately address. There's also a risk that Albemarle will seek additional expansion, but without direct assistance, we believe this to be highly unlikely due to the company's funding constraints. With a $95.50 year-end target price, we recommend a sell for Albemarle due to its business mix and contracts limiting profitability, its balance sheet working against shareholders, and the mischaracterizations of the company. Thank you. We will now open the Zoom for questions.
Thank you. Judges, please turn on your videos. Okay. Please stay muted unless you are speaking. I will start time as soon as the first judge utters the first word. Time will end at 10 minutes. Feel free to begin.
I don't know if I can address the first question. First of all, thank you for the presentation. It was like a great presentation. My question is related to reserves. Do you consider at some point, or how did you consider within your valuation the reserves that the company can have?
Obi, would you go to the reserves? E8, please. So there are lots of lithium capacity across the world, but Albemarle's capacity is restricted because of its funding constraints. And so there are 3 projects that the company has coming up. Obi, if you want to go to the CapEx slide to show those, that we have forecasted into our model based on their estimated CapEx spend. But other than that, the company has not announced that they will increase their capacity beyond 2025. We assume that they will to keep up with demand. That's a part of their strategy. But this is what we have in our model. And with just those 3 projects, they'll nearly triple their capacity in the next 5 years.
To build on top of that, Obi, could you please go to financial leverage?
Yes, sir.
In the last earnings call, management gave guidance that they want to lower their debt to EBITDA to 2.5. As of the last quarter close, it was above 4. And the only way that they're going to be able to do this really is to start redeeming notes early, which we've seen them do recently with issuing new shares. But Obi, if you could go to the bull case now. In our base case assumption, we have them delevering in accordance with their guidance, but we also stress test our analysis under the assumption that management will maximize their debt to EBITDA ratio, directing all of the funding towards capital expenditures, growing lithium unit volume very significantly. But even in this scenario, our sell recommendation still holds.
Okay, thank you.
Guys, help me with, I think it was your slide 8. If you have fair value at $95.50 a share, and the company just raised $1.3 billion at 162 or so, wouldn't that be considered a good use of capital to fund CapEx and conceivably to pay down some of the debt on the balance sheet?
Yes, we agree that if we were the CFO of this company, we would be directing as much funding as we could towards capital expenditures. The problem is that the company is really dedicated to lowering its total debt ratio, improving its credit rating, maintaining a stable dividend. It's trying to paint the picture of itself as a stable dividend aristocrat, whenever really it's being valued as a fast growth company in a high growth industry. There seems to be some conflicts there.
Let me ask you a follow-on to that. On that same slide, you show a 5-ish% return on invested capital. What were returns on capital prior to the COVID year, and how fast do you see them recovering to those levels?
Obi, I believe we have a slide on return on invested capital that has historicals. Yes, so the return on invested capital hasn't been anywhere close to our WACC except for in 2018 when the price of lithium peaked. And we don't forecast it coming close to our WACC in our forecast either, because the return is just, it's not enough for how much they're having to pay to bring on all of this additional capacity.
I'll take the next one. I believe you have an income statement that you've modeled financials on. I saw that gross margins were as high as 35% in 2019, but declined to 33% after that. And I believe you hold it steady at around there for a while. What caused that decline in margins?
Obi, can you go to profitability first, please?
Yes, sir.
Let's look at it from a historical perspective first. If you would please look at the gross profit margin in the top left slide. As you can see, lithium prices peaked in 2017 and 2018, and so did the profit margins of the entire industry, of the lithium industry. Albemarle's, however, stayed pretty flat over that entire time period. We believe that there are two reasons for this. One, there are other two segments, bromine and catalyst, are fairly stable and they offer as a hedge against the company. And two, 90% of the company's lithium unit volume is already contracted out, and those contracts last 2 to 5 years. So in times of falling lithium prices, it keeps their margin steady. In times of increasing lithium prices, it keeps their margin steady. So in our forecast, if you could go to the gross profit margin slide, please. We do increase our gross profit margins in line with us expecting an increase in spot price of lithium. However, the benefit that Albemarle sees won't be anywhere close to what the rest of the industry sees.
Thank you.
And first, great presentation. And one of the questions that I want to ask about is, I see that you've taken a contrarian view to this stock relative to some of the other analysts who cover it. I would love to hear maybe an opinion on, do you have a strong sense of what you think might be causing, from your perspective, some of the marketplace misvaluations from your perspective, from a sell recommendation compared to some of the other analysts?
I'll start and then someone else can jump in if they want to.
Yep.
Just this week, we read an analyst report, and it was interesting because they talked about how Albemarle was one of their top picks in the lithium industry because the price of lithium was going to go up and demand is supposed to be so robust. And we forecast all of those things into our model. But what we're seeing is the contract structure for these companies is very secretive. And we found that the company contracts 90% of their lithium volume from just a small part of one of the earnings calls. They briefly talked about their contract strategy. And so I believe that part of the misvaluation is that there are little bits and pieces of information that only come out once and in a very short amount of time. And because we've been researching this company for probably 6 months now, we're able to pick up on those small details and incorporate them into our model.
Additionally, one other analyst from Citigroup mentioned 2021 as the year of volumes, which is where he was getting much of his optimism for Albemarle from. However, through our research, and I'll go back to the CapEx slide here, we can see that the two of their capacity aren't expected to come online or be done until 2021. Then they have to go through a 6-month certification process. So that will prolong that use of capacity even longer. And then beyond that, the addition, the final project that is which the time period is currently unannounced, but which would bring their capacity to 225, isn't expected to be completed until 2025. So while we understand some of the optimism, we believe a lot of it is a little premature.
I'd also like to emphasize that we're not contrarian with respect to EV adoption and lithium demand. We just don't believe that, given the company's timing for bringing on capacity in their contract structure, is going to be able to see the same benefit as the rest of the industry, like we've mentioned.
Guys, if the book value of the company was $4 billion and presumably over 5 after the equity raise, you have a weight of equity in your cost of capital of 93.9%. What number are you using for equity in that blend between debt and equity?
Obi, can you go to the WACC calculation, please? For our percentage weights on the cost of equity and the cost of debt, we use the company's market cap of 17 billion, and then its net debt, which we anticipate being in 2021 of approximately 3 billion. Of course, whenever they issued those shares, they paid off that debt. It shifted those weightings up, giving more weighting towards equity as opposed to debt.
Before
I have
I'm sorry. Before
Go
they
ahead.
issued the shares, their WACC was around 10.3 or 10.8%, and our ROIC forecasts were still not above that WACC.
Let me ask you this. If you use the book value of the company instead of the market value of the stock and assume that debt and equity were roughly equal and the weighted average cost of capital was much lower, would that materially impact your valuation of the company?
Toby, can you please go to alternative multiples?
Absolutely.
We considered using a valuation based on price to book. We ultimately didn't use it because it's the opinion of the group that whenever you have a company as long-standing as Albemarle, we prefer to value based on operating.
Time. Thank you, Appalachian State University.